I'm Lynette Zhang, Chief Market Analyst, and welcome to ITM Trading, a full-service gold and silver brokerage house in physical form, specializing in developing custom strategies to help you get through and then thrive on the other side of the upcoming reset. And, we've talked in the past a lot about Deutsche Bank. We have to pay attention to them because according to the International Monetary Fund, the IMF, they are the most dangerous bank. And I'm going to show you why. But this is the critical development. We've been talking quite a bit about con games, right? And in any con game, it requires confidence. That's why they're always checking consumer confidence, inflation confidence, all this confidence. Because when people lose confidence, they make different choices. They take their money out. And so we're going to take a look at how Deutsche Bank, along with their high-risk derivative bets, can topple the next crisis, because even though the markets have lost confidence in Deutsche Bank, and we're going to talk more about that too, now the shareholders are starting to lose that confidence. And if they lose that confidence in Deutsche Bank, well, there's a run on the bank, which means that those investors and those shareholders will pull their wealth out of Deutsche Bank. And I'm going to show you some interesting developments that happened in the most current quarterly financial statement, because market confidence has already evaporated. I mean, it's down 94% since 2007. What's that telling you? They don't have any confidence in Deutsche Bank because they know how vulnerable it is. Now, you might say to me, well, hey, they've been in this shape for a long time and they keep hanging on. Well, they still had shareholder confidence. And that is starting to dwindle. So we have to keep an eye on it, because if you can recall what happened in 2008, it was in March of 2008 when Bear Stearns had a run and investors and shareholders pulled their wealth out. That stock plummeted, and then JP Morgan's, how they got their silver position, both physical and actually digital, was how they got that position. It was bailed out, or it was absorbed by JP Morgan Chase with a whole lot of taxpayer money. So if this happens in Deutsche Bank, it will overwhelm. The most likely outcome, obviously it's beyond my control, but the most likely outcome is that it will overwhelm the central bank's ability to keep it alive. And they need to keep it alive, because when they don't, this can pop the everything bubble. Because we know stocks are severely overvalued, bonds are severely overvalued, derivative bets, which we're going to talk more about, are severely overvalued, and so is real estate. And these bubbles have already started to pop. We've got to pay attention to this. But just focusing on Deutsche Bank a little bit more, the cost, now they issue debt, right? And then there are some speculators or legitimate people that have loaned Deutsche Bank money that use CDS, which is a derivative that's based upon the claims paying or the debt paying ability of the company. So their CDS, that cost, have risen pretty dramatically over a short period of time. And in fact, they say that Deutsche Bank's overall risk is increasing as longer-term liabilities are rolled into shorter obligations. In fact, their bail-inable bonds came out at 99 in February of 2018, and they're already selling at a pretty big discount, a little bit more than a year later. But understand that senior bonds were a sacred place. I mean, they would get paid ahead of everybody. But in 2017, all of Deutsche Bank's senior debt, that before that was first in line, it all became subordinated debt, which is one reason why the costs have gone up, because that means it's all bail-inable. So Deutsche Bank becomes insolvent and there is a run, a lot of people demanding their wealth out of it. Whatever you have in those senior debt bonds, not the new ones, but these old ones, as well as the cocoa bonds, it's getting bailed in, as well as the deposits are getting bailed in. And that won't be enough to save them either. But, of course, it's a problem for Deutsche because it's costing them more to fund their debt. So, rather than change behavior, this is what they do all the time. They just change either the rules, the laws, or they create a new product, which now there's a CDS against the non-bailable senior debt bonds, the new bonds of Deutsche Bank. They came out at 99. Let's see where they'll be trading in a little bit of time. Probably look similar to the cocoa bonds that you can see here. Doesn't matter what your perception is. That is not valid in a court of law. So some people may perceive them as safer because, after all, they're at least at the moment trading at half of what the other CDSs are trading at. So it looks like Deutsche Bank can do this with half the expense. Yeah, for the moment. Because frankly, the revenues at Deutsche Bank has gone down a whole lot more than the costs have. In fact, 7 out of the last 9 quarters, they're showing some pretty significant losses. And that doesn't include the litigation costs. And we know Deutsche Bank spends a lot of money on litigation. I'm going to show you that in a minute. But all of this actually supports the sovereign debt doom loop. There are 2 doom loops that we're actually going to look at today, because this is true for all of the European banks, or at least most of the European banks, that over the last 3 years, they have not earned more than their cost of capital. They've not earned more than their cost of capital. That's even with all the derivative bets. This is not a good thing, people. That's like, their outgo is more than their income, and they're highly, highly leveraged. And it isn't just Deutsche Bank. It's really almost all of the European banks. That's what that looks like. I mean, they have been smashed and crashed because they are all insolvent. I don't care that they do the stress tests and they make it look like this or they make it look like that, or they change the accounting year, or they change how you account for this there. The bottom line is that the risk is great. The markets recognize the risk. But this could be a huge pin. I mean, Deutsche Bank's not much above €6 right now, but a lot of the other banks are in a similar circumstance. And so you can't talk about Deutsche Bank without talking about their derivative bets. Now, a derivative is just a risky bet, and it's based on the price action of the underlying whatever. So the underlying stock, the underlying bond, the underlying credit quality, all of that kind of stuff. That's what a derivative bet is based upon. But you can't convert it into anything other than dollars, and that is presuming that there is a market for it. What I'm showing you here are the level 3 assets. Now remember, gold in the banking system is a tier 1. A level 1 asset means very, very liquid, easy to buy, easy to sell. But all of these are tier 3 assets, and they are a whole lot less liquid because there are just not that many buyers. And going back to these derivatives, which are all about leverage, that's what it's about. just leveraging debt, leveraging stocks, leveraging price action, leveraging everything, right? So leverage, most of their portfolio is either leverage or debt. And they're leveraging that debt. I mean, it's complicated and it's crazy. In fact, we may be trying something new. I'll talk to you about that in a little bit. But these derivatives, most of them, roughly 90% or more of them, are done over the counter, OTC. And when they're done OTC, typically there's either two or three bilateral or trilateral trades. That's it. So there's a very limited market. There's a very limited base of buyer. And that's why, like 2008, when we saw the credit markets freeze within 24 hours, you might recall that, especially those that were working in real estate and mortgages during that period of time. If you had a whole bunch of mortgages on your books that you were getting ready to close, what happened to them in 2008? Bam! They evaporated overnight, gone. And we know this. That's what happens because there are no other buyers for it. Now, since this period of time, and I want to take you back a little bit, because what we know is that in 98 you had long-term capital management, and that was the first derivative explosion that threatened the global financial system. Taxpayers and Wall Street banks bailed them out. So most people don't even know that that was an issue, but it was. Rather than putting oversight into them, what did they do? They took a hands-off approach, and not only did they take a hands-off approach, they said, well, banks can self-regulate, because certainly they would care so much about their reputations that they wouldn't do anything to sully that. Well, 2008 showed us how that worked. And instead of reining them in, no. Instead, what they've done is they have expanded their use so that prior to 2008, if you were sitting, you might have been in a hedge fund that had derivatives, like some of the Bear Stearns funds that went from like 6 billion to zero overnight. But then you I hate the word should, because as soon as it comes out of my mouth, I know it's not true. But in theory anyway, these were more sophisticated investors that should have known what they were getting into. Well, today, and I've done other videos on this, so we'll put the links to the other derivatives. Derivatives have now infiltrated your mutual funds, your ETFs, and in central bank balance sheets, because the central banks took all the derivatives, or a lot of the garbage derivatives, off of the bank's books, and we taxpayers are responsible for it. So there is most definitely another derivative explosion in our near future, and Deutsche Bank could be the trigger of it, because their derivative book is many, many times the Germans' gross domestic product, which is all the money that flows through Germany's economy. You can't bail that out. And I'm going to show you why that matters to you in just a heartbeat of a minute, even though it's something I talk about all the time. Because in this first quarter in 2019, Deutsche Bank has increased their leverage. So what you're looking at here is that for every 3.9 euros in equity, they have 100 euros in debt. Put another way, if their assets fall 4%, they are insolvent. Now look, they've done this before, falling below that ratio and been in the insolvent camp, because bottom line is they are insolvent. And so a lot of people will say to me, oh, but Lynette, they've been insolvent before and they haven't gone under. Well, the difference is that the shareholders have not created or run the investors in Deutsche Bank that have loaned them these monies in these bonds, have not run on the bank. And it's very, 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 very significant that we have begun to see shareholder confidence wane. Because when it's lost, that's when the run occurs. And there's just really no bailing this out. And that's really the biggest reason why it matters to you, because we've looked at this before. Here's the bank doom loop. Everybody is incestuously connected. Now, in 2016, the International Monetary Fund, IMF, named Deutsche Bank as the most dangerous bank in the world, because as you can see from their graphic in here, here's Deutsche Bank in the middle. And you see these lines? Those go to 8 key US banks and 14 key European banks and 6 key Chinese banks. But what I also want you to look at, so they are directly connected. And by the way, if you go in and you click on the links and you look at this graphic, you're going to notice that the size of the lines connecting them will vary. That tells you how big that connection is. But there is a key connection in every single one of these globally important banks, SIFIs, systemically important financial institutions, global universal institutions. And I really want you to think about those words, global universal, because what they are really telling you is that on some level, all of these key banks are connected like spider webs to all of the smaller financial institutions. So you feel safe in your community bank or in your credit union or in an online bank or entity or whatever. You feel safe there because that's your perception. But look at how they are tied. These gray lines in there underneath all of the more colorful ones, they're showing you, the IMF is showing you how interconnected everything is. So if Deutsche Bank catches pneumonia, it could easily kill the entire system. And I need you to see this really, really clearly, because we always think, that's over in Germany. What does that have to do with me? Or that's Deutsche Bank. I don't bank at Deutsche Bank. It doesn't matter where you live. It doesn't matter where you bank. That's why I personally do not keep a whole lot of money, fiat though it may be. I don't keep a whole lot of money in the bank. Because let me tell you, this whole thing since 2008 has been set up to bail in, which means the wealth that's kept in the system will evaporate. And it still won't be enough for these banks because of how highly leveraged they are. The bottom line is, we are in deep doo-doo. No doubt about it. And the epicenter of this next crisis could easily emanate from Germany. So does Germany do? Well, they repatriate their gold. And even CNBC says they must know something that we don't. Well, they know everything I showed you. They know more. And what they also know is everything is so precarious that we are absolutely counting on them doing every kind of experiment, every kind of bet, every kind of everything 100% perfect when they have no idea what they are actually doing. Shocker. So I just want to point out these bank levies that pushed the adjusted costs for Deutsche Bank up so much in the first quarter of 2019. Because what that really means is that every single lawsuit, every single levy, every single subpoena, everything, that's how many times Deutsche Bank has made mistakes and been caught. And been caught. We don't know how many mistakes or how much illegal stuff or whatever else that they did, and they didn't get caught. But we do know about those levies, and let me tell you, we're going to talk more about that next week. Super interesting. I just kind of pulled up here the spot gold. This is from that March quarterly financial about the litigation that they have going on in spot gold and silver. Boy, shocker. Okay, well, they settled the one to manipulating, where they admitted manipulating gold and silver, and they're giving up all the other banks that were involved in this manipulation. I mean, admitted manipulation in gold and silver. Now, look, it took a long time for even that to happen because, as we know, a rising gold price is an indication of a failing currency. But there's still manipulation. They're currently defended in 2 class action suits in New York. They have tentatively agreed to the settlement, but you know, these settlements have become just a cost of doing business. And they're defended in Canadian class action lawsuit involving spot gold and silver. Now they're trying to settle it because, again, it's a cost of doing business, but they already don't generate enough income in everything that they're doing to cover their cost of business. And none of the big banks in Germany do. And I dare say that's probably true in more cases than that. But that is how it can tip over and trigger this whole thing. So now I'm going to take questions. And Robert J. asks, does the government still have the ability to try and save the too big to fail banks? The answer is no. They used all of that up with all of the quantitative easing. So all of these banks that were too big to fail in 2008, they're a whole lot bigger. And now they are too big to fail, they are too big to bail, and they are too big to jail. And finally, they are way too big to stop. It is too late. We cannot turn this ship around. You cannot turn an ocean liner around in a thimble of water. Not possible. So no, they do not have the tools to do that. And Master Mindful says, how interrelated are the commercial banks from central banks and from the biz? Do they relate to direct government oversight? Are they merely connected by contracts, deals, or also by regulations? Actually, they are, you know, the commercial banks are tied to the central banks because they are actually the ones that put out into the economy the policy of the central banks. So whether or not they want to stimulate, which really means get people to borrow and spend more money, or if they need to tighten, and they do that by raising the rates. But the commercial banks are essentially an arm of the central banks. They do have contracts, and I'm actually going to go a lot more into the interrelated nature so that I can take all of those on that level. So Master Mindful, if you would just give me a minute, I'll do that within the next couple of weeks because I think that's a great one. It's one that we were talking about doing yesterday. And I'll do one on all of the different levels of interconnectedness. And Megan, could you mark that question for me, please? Okay, thank you. And Molktra 90 Reese, Deutsche Bank going to get a bailout. Well, see, that's the problem. The problem in Deutsche Bank is it's way too big to bail out because their derivative book is many, many, many times Germany's GDP. And remember, too, when I say their derivative book, what I'm really talking about is the nominal value. And what that actually means, it's the value that the market has decided that this particular derivative, risky derivative bet is worth to buy and sell, presuming that there's even people on both sides of that bet. That's why they're illiquid. So when it happens in Deutsche Bank, let me go back to that slide here. Okay, when it goes back to Deutsche Bank, I mean, some of the banks that they're connected to, Santander, well, we know, Soc General, Credit Agricole. I mean, I can go through this whole list, But once it erupts in Deutsche Bank, all of those derivatives are tied to all of these other banking institutions, JP Morgan Chase, Wells Fargo, Bank of New York, Goldman Sachs. They're all tied together. So no, it is impossible. And I don't have this data in front of me, but we'll put up links for the rest of the other derivative, because I've done quite a few videos on derivatives because I want you to understand it so much. But if I remember correctly, so don't hold me to this, but we've got the data there. The nominal value or notional value of the derivatives is something like 2,200 or 22,000, the global GDP, which is GDP is all the money that flows through the economic system. Now, I'm not saying all of the derivatives would erupt at once, but frankly, they could, because what we don't know, think back to 2008, when you had the central bankers coming out and going, well, okay, it's just subprime mortgages. That's going to be contained. That's not a very big part of the market. So this is as bad as it's going to get. And then another shoe dropped. Oh, well, that's it. This is as bad as, and then another shoe dropped. And the reason is because they slice and dice these big risky bets and they commingle them in ways that nobody really knows. And all of those risky derivative bets that froze the market in 2008, they're still there. They're still out there floating around. And as long as payments are made, well, they can keep floating around. But the problem with what we're looking at is that credit could freeze, not be paid. And think about 2008. Bam! Overnight, it was frozen. Overnight. And to be perfectly honest with you, when Lehman went out in September, and that was my alma mater, that's where I first became a stockbroker. So you know I was paying a lot of attention to what was happening with Lehman. I could not believe that they would let it go down. Been around for 125 years, really, a fantastic reputation, et cetera, et cetera. Gone. Created a credit crisis that they couldn't overcome without a massive injection into the system. And they've been making that massive injections ever since. And it was effective in 2008 to reflate the economy, all that QE. So they've used up all their ammo and they know it won't work again. And we've been watching the shifts with all the yield curve inversions. That's what that's telling us too. We are in deep doo-doo. Smelly Butler says, so literally, Lynette, I guess you mean if Deutsche Bank fails, which it will, all these banks are going to fail too. One word. Yes!